In this series of videos, we're going to talk about accounts receivable. I thought the most logical place to start was just to give a definition of accounts receivable. I was looking for it online, and I just did what any good internet user would do. I Googled definition of accounts receivable, and this is what Google came up with, and it's a pretty good definition. It says money owed to a company by its debtors. Now, what does that mean? It means that we did some work for a customer, and the customer hasn't paid us right away. So they owe us money. If I'm owed money by a customer, and it's, typical short-term transaction, I do work for them, I send them a bill, they don't pay me right away, they're going to pay me in a week or two, that represents an account receivable to me, and it represents an account payable to them. They owe me money, I am owed money. So we're looking at this from the perspective of being owed some money. And so I just want you to think about accounts receivable for a moment from the perspective of a company, and think, why would a company offer accounts receivable? That's a real million-dollar question. It took me a long time, probably longer than it should have, to piece this together, but it's always something that I wondered about as a student, and I wondered about when I was early on as a professional. I thought, why offer accounts receivable? And I thought of it from a very selfish, lazy accountant perspective, and I said, well, a cash customer is much better. Let's think of a customer that pays us in cash. So let's say we do consulting work for a customer and they pay us $1,000 for the work. So today's February 26th, and I do $1,000 worth of consulting work, and they just pay me right away. So I debit cash because I've been paid right away for $1,000, and I'm going to credit consulting revenue. Oops, consulting. Sorry about that. Consulting rev for $1,000. Okay, so basic transaction. I was paid $1,000 to do consulting work, and then I thought, okay, now let's compare that to accounts receivable customer, a customer that I give credit to. So in other words, I do a bunch of consulting work. Rather than collecting cash right away, I give them a bill and I give them a month to pay. And I'm going to compare the normal cash customer to the dream credit customer. So on February 26th, a customer comes in. I do a bunch of consulting work. I do $1,000 worth of work, but they don't pay me right away. So if they don't pay me right away, I'm going to debit accounts receivable. Remember, accounts receivable is a current asset. We're owed money. Our accounts receivable is going up as a result of this transaction. Debit AR by $1,000, and I'm going to credit consulting rev for another $1,000. Okay, fair enough. Now let's say they're our dream customer and they pay us right away. So they don't even wait the month. We give them a month to pay. They pay us after a week. So it's like March 2nd, or I'm not sure if that's a week later, maybe March 5th. And they pay us. So of course we get cash of $1,000, and we credit not consulting revenue. We've already credited revenue. We don't want to record double revenue here. We're going to credit accounts receivable to say we no longer have this receivable. Again, a credit to AR makes it go down. So we said we had $1,000 in receivable. We don't have it anymore because they've paid us. Okay, so being the lazy accountant that I was, I looked at this situation, I compared the two, and I said, well, the best receivables customer in the world takes me 2 times the journal entries and 2 times the work compared to a cash customer. They only take 1 journal entry. They take half the work. And so I thought, why is every company I'm working on and doing audits for, or working with, why does every company I'm visiting offer credit? Why do they let their customers have accounts receivable? It seems like a lot more work for the accountants. And not only was it a lot more work for the accountants, double the work in terms of journal entries, it was actually honestly way more work because not every customer is a dream customer. What about the customer that takes their month and it's March 26th and they still haven't paid? Well, that means it's a phone call from you to remind them that their bill's coming due or overdue. Then if they don't pay a month after that, it's off to a collection agency, or it's more hassle, and it's way more work to do receivables. It's way more work to offer your customers credit. And so I thought, why bother? Why not just take the cash right away and, be done with it? And the answer, I'm here to tell you, is very simple. The reason companies offer credit to their customers is because if they don't, their competitors will. I often imagine my university is a huge buyer of office supplies, and I think they buy from like Pitney Bowes or some company like that. But I like to pretend this scenario happens. Let's pretend that there's two big office supplies companies in town here, Staples and Office Depot, and those are the two big office supplies companies, Staples and Office Depot. And so let's say TRU, my university, goes to Staples and they say, "Hi, Mr. Staples, we'd like to buy some office supplies." And Staples says, "Absolutely, buy office supplies. And by the way, we'll only accept cash." TRU, a big institution, would say, "No, we'd like you to send us a bill. And by the way, if you don't give us credit, the competitor down the street will, and we'll go to them." And so it's something that companies kind of get their hands forced by customers desiring this. They want to have credit. It's beneficial to the customer to get the bill and pay a month later. And so it's the way business gets done. So most companies that I worked with do offer credit in one form or another. And so that's why, even though it's a heck of a lot more work, that's the reason that receivables exist and are just commonplace in business. Now, further complicating this for accountants, and part of the more to my point of why I didn't like dealing with them, is not the fact that they take double the work, and not the fact that it takes 2 journal entries rather than 1. The reason I didn't like dealing with it as a young accountant is because it's a real pain in the neck when customers don't pay. Dealing with the fact that customers don't pay is a huge hassle. And I'm going to show you why it's a huge hassle, and that's going to be the focus of your week in your class if you're doing accounts receivable. This is the real fundamental issue with accounts receivable, and I'm going to explain by way of example. So I'm zooming back in a bit. Okay, so let's again say we're offering credit. I must have zoomed in way too far. I can see that's a little bit big. Let me zoom out there. That's going to be better. So again, I'm offering credit. This time I make the sale on, let's say, December 15th. I make a sale, and it's on account. So I debit accounts receivable for $1,000. Exact same transaction as before. I do some consulting work, and I credit consulting revenue for $1,000. I'm not sure why my pen kind of chose to erase itself there. Try that one. Okay, so debit accounts receivable, credit consulting revenue. Now let's pretend that my fiscal year end, I thought that would work. It seems to have made it worse. I'm going to try. Well, we'll keep going. My fiscal year end is December 31st, and it's time for me to make financial statements. And so I issue my financial statements, and the customer hasn't paid right away, but who cares? They don't owe me for another month, so I give them credit. I say, you pay me in a month, and we'll all be good. And so December 31st, I do my income statement, my balance sheet, my statement of retained earnings, my cash flow statement. That's something you probably haven't learned yet. My tax return. I do everything featured around that December 31st date. And so January the 15th rolls around, and I call the guy that owes me the $1,000, and I say, "Hey, you owe me $1,000, and it's due today." And the guy says, "I'm going to need just a few more weeks. I'm sorry, I can't afford it. Just give me a couple more weeks." And I'm a big softy and a big wimp, and I say, "Okay, take a couple more weeks." So I give him till the end of January. It's January 31st. I call him again, and I say, and I get another sob story. He says, "Just a few more days. It won't take me that long. Please, just, I just need more time." So now it's Valentine's Day. It's February 14th, the most romantic day of the year, a very sad day for people like me. And I call him and I say, "Hey, buddy, look, well, I've given you an extra month here. Why don't you just pay up? You need to pay up now. And well, that's what I'm thinking. And as I call, I get the number you have reached is not in service, and I can't find the guy. And I try to track him down, and he's nowhere to be found. And I begin to think on this day, maybe this guy's not going to pay. And this is the big pain of giving credit, is that not every customer pays up. Some go bankrupt, some disappear. There will be a time, if you offer enough people credit, somebody is not going to pay you. That's just a reality of offering credit. And that creates this expense. And the expense is called the bad debt expense. And I've also seen it called the uncollectible accounts expense. I've seen it called a number of different things, but for our purposes in my video, we're going to call it the bad debt expense. And that's just for, like it sounds, when debt goes bad. When somebody owes us money, their debt goes bad. It's rotten. I'm never going to get the money. So you might think, okay, well, it's February 14th, time for a journal entry because this guy's never going to pay us, and the bad debt expense comes into play. Now, this is the wrong entry. I'm just telling you right now what I'm going to do here is the wrong answer. But you might be tempted to go, okay, debit bad debt expense. It's $1,000 that we're giving up on, and we'll credit accounts receivable because, look, this guy, I mean, he legally owes us money, but we don't think we're going to get it. We certainly don't have $1,000 asset, current asset, that we're going to get paid from him. So get rid of his account receivable. Credit accounts receivable for $1,000. And you might think that that's a logical entry, and in fact, it kind of is a logical entry, but this entry is wrong. This is called the direct write-off method, and this goes against GAAP, it goes against IFRS, it goes against the rules of accounting, and it goes against the specific rule of accounting called the matching principle. And the matching principle says we need to match expenses with the same period as the revenues that they're earned. So let me put a year on this. This is December 15th. Oh, my pen is just making me crazy today. This is December 15th, 2012. This is December 31st, 2012. And this is January 2013. Why is it every time I make a 1, it disappears? And so this is February 14th, 2013. And so what the matching principle says is we need to match the periods of when we earn revenues and the related expenses. So if I record a bad debt expense in my fiscal 2013, and it's fiscal years that matter, not calendar years, it just so happened our fiscal year ended on December 31st. But I'm recording an expense in 2013 that relates to 2012 revenue. I am violating my matching principle. So what does that mean? It means I need to record the bad debt expense related to this revenue. I need to record it on or before December 31st, 2012. I need my bad debt expense to be recorded here. Now, I hope you're beginning to see the problem. This guy, we did some work for him on December 15th. We did $1,000 worth of consulting work for him, and on December 31st, we were owed $1,000, and we said, yes, this guy owes us $1,000. It was a legitimate account receivable. It was correctly recorded as accounts receivable in the financial statements, and I had no idea this debt was going bad on December 31st. I would never call the person and say, hey, are you thinking about not paying? No. I thought it was good debt. I thought I was legitimately owed $1,000. In fact, January 15th rolled around. I still thought I was going to get the money. January 31st, I still thought. I didn't know until February 14th that the debt had gone bad. But I need to record my bad debt expense on December 31st. Now, how do I do that? The answer is what we're going to talk about in our next couple of videos. But the answer is I estimate. So I take a guess on December 31st, and we're not going to actually learn how to guess. We're going to learn how to deal with it, with this situation. So on December 31st, I need to say, okay, look, I have lots of people that owe me money. Clearly, I think they're all good, but Clearly, if I have a lot of people that owe me money, somebody's not going to pay. I need to estimate my bad debt expense. So this chapter in any textbook is all about how companies estimate their bad debt expense. And we're going to learn 2 ways of estimating the bad debt expense. In the next video, we're going to talk about the income statement method, also called the percentage of sales method. In the following video, we're going to learn the aging of receivables method, also called the balance sheet method. So those are the 2 ways we estimate our bad debt expense, because we can't wait for the debt to go bad. I can't wait for February 14th for me to realize this guy's not going to pay. I have to make an estimate on December 31st of my bad debt expense. That's the focus of the next couple of videos. I hope they are useful to you.